Butler is kindly going to be presenting on climate change scenario analysis. I'll introduce Justin, who's a leading expert and advisor on the scientific development and commercial applications of flood and climate change analytics for risk management and loss modeling. He founded Ambiental in 2002 following his Ph.D. in hydrology and applied mathematics from Cambridge University. And Justin's primary focus is assisting risk managers, underwriters and asset managers to reduce negative impacts from natural hazards while improving strategic planning and business resilience. So I'll hand over to Justin.
That's great. Thank you very much, Martin. Can you hear me okay? Great. Can you hear me okay?
Yeah, we can hear you.
Good, lovely, thank you. So just to crack on then, so today I'm going to be covering a few key points from the June 2020 CFIRM guide. So that's the Climate Financial Risk Forum, written by industry for industry to help companies better approach and address climate-related financial risks. Also starting to then look at, how bad could it get in the UK, so what recently released UK climate projections mean for the insurance finance industries, and also how can we move towards more meaningful scenario analysis using a case study of UK flood, and hopefully be helping risk managers to improve the way they disclose in relation to climate change, but also perhaps more importantly as well, just to change the strategic direction of their day-to-day business as well to accommodate climate change risk. So in terms of the UK, this slide here summarizes results from the Met Office and other organizations about what the current state of the nation is with regards to climate change. So every 8 years or so, the Met Office publishes the UK climate programme, and interestingly, climate models are now at a similar resolution to operational weather forecasts. So this particular iteration means that we can now model down to a grid scale of about 2 kilometers rather than 300 kilometer squares as previously. So that gives us much better granularity in terms of what the future is going to look like from a climate perspective. And some of the key statistics are quite alarming in that, rain from extremely wet days has increased by almost 20% during the most recent decade compared to the period 1961 to 1990. And both summers and winters have been wetter over that same period, over 12%. And even when it comes to the smaller high frequency rainfall events, the 1 and 2 year event, we've seen an increase of about 25% in terms of that, the amount of water that comes from that event. So flood damage, as many insurers know, currently costs the UK over £1 billion a year. And even by 2050, coastal damages alone could account for 12 billion every year by 2050. And if we look at the more global scale as well, the WRI have estimated that twice as many people will be affected by floods in 2030 as compared to 2010. So it's about 150 million people in total. Next slide, please. So in terms of the use and the benefits of climate change scenario analysis, so how can we actually start doing this? And what is the key drivers? Well, obviously climate change could substantially affect the values of all types of financial assets, and even the way that investment managers deliver value to their clients is likely to change, given that assets as well as the nature of exposure for insurance companies, for example, is changing over time. There's quite a lot of background noise, Martin. I don't know if we can just mute everybody except that.
Sorry, that was mine. Yeah.
Okay. And
I'll mute it. I'll mute myself.
So obviously, when we're looking at the effects from climate change, given that there could be increases in the cost of insurance for some, or even reductions in the availability of insurance for others, we need to look at both the direct effects as well as the indirect effects from climate change before we can start mitigating those. So when I talk about direct effects, we're referring to corporate balance sheets that are impacted due to loss of output or cost of repair from flood and other types of perils. And the indirect effects are the more long-term chronic changes which impact aggregate demand and output. So disruption to supply chains, for example, or the adaptation costs which impact upon inflation and interest rates or long-term productivity. So those effects combined are likely to impact the way that assets are valued going forward. Now, we're going to be focusing today primarily on physical risks, so the direct physical impacts of climate change on assets rather than the effects of transitioning to a net zero carbon economy. But I think a key point here from this slide as well is that regulated firms now need to consider material climate risks as well as opportunities as part of their business plans and investment decisions. And the CFIRM, as I mentioned at the beginning, is now composed of some big organizations, HSBC, RBS, etc., have come together after the establishment of the CFIRM by the FCA and PRA in 2019. So there's lots of potential impacts here, and the real thrust of climate change scenario analysis is try and help us ascertain what those direct physical impacts might be. Next slide, please. So in terms of getting started with climate scenario analysis, what is it and how can we go about it? And also, why bother? It's not just about long-term planning, it's also about business decisions now that we have to make. And we can actually distinguish between the shorter term business decisions, where it be kind of underwriting, pricing, or risk selection, or management of specific utility assets in the floodplain, all the way through to long-term strategic investments in the stock market, for example. So it's not just about the long term. And the three-stage approach that we've working with recently with our clients in this area is firstly define what the objective is. So given that scenario analysis can be used to support strategic analysis, like whether or not to invest in new business opportunities, which may prove to be more or less lucrative, but also what are the most material exposures, what countries or sectors or companies are most impacted by these different scenarios. So really defining what the objective is and what level of exposure we're comfortable with tolerating. Then the next stage is what type of scenarios and risk metrics need to be considered given our objectives and the exposures to risk that we have. So that might be, for example, selecting the appropriate emission or temperature pathways. Are we looking at high, medium, or low emissions futures, or 2050 versus 2030 or 2080? What's our time horizons? And also definition of those risk metrics in terms of, is it that our credit rating that we are concerned about in the future, or market valuations? And then obviously as well, selecting the appropriate impact assessment tools, both internally and from third-party vendors. So the final stage then is also looking at how the impacts are then translated into financial metrics, whether it be impacts to P&Ls or capital ratios, and what actions then need to be taken. So one thing that I've kind of called out here on this slide, it's very important, if you're not doing so already, to start collecting data on the location of suppliers, facilities, customers, and sales, both for the transition and physical risk aspects, because it's those interrelationships which are really important to have data on. Next slide, please. So the good news is that the data and the analytics is already out there to help, and we've developed a lot of these tools and already supporting risk managers, as I say, to assess and plan for the effects of climate change in their portfolios. And in terms of the scenarios themselves, as we can see here, whether it be choosing between the high, medium, or low emission scenarios, and also what kind of probability levels we feel comfortable with and accepting and measuring ourselves against. A lot of these tools are, as I say, are available. And as Martin mentioned earlier as well, IRM's special interest group in this is developing a practitioner's guide, which will also help kind of materiality assessment over different time horizons and how to design those scenarios. Next slide. And the kind of things that we're doing now are working with clients to understand their supply chain risk, as well as specific location risks for assets in areas in the UK and internationally. So if we think back to the Tohoku earthquake, for example, back in 2011, which caused a tsunami and basically put back iPhone production by 6 months. The whole contingent business interruption piece can be approached directly, looking at changing frequencies and magnitudes of natural hazards, including flood and hurricane, but also looking at the interaction between supply chains and using tools to see how they link with each other and finding the weakest links in those supply chains. And that's, as I say, why we need the data collected on them. Next slide. And here's some realistic climate change scenarios that we built for a customer in the utility sector. So this is actually an area in Bristol, looking at an industrial estate area. And what was of concern here was the likelihood of increasing pluvial flood risk. So that's heavy cloudburst type flooding and how that might change over time. So what we can see here is the 1 in 100-year event over 2080 for a medium and then a high emission scenario, as we can see there, just kind of rolling through the different simulations. So as we can see there, under a medium emission scenario for this particular location, that particular scenario for pluvial risk is a bit worse than it is now, but under a high emission scenario, should we follow that pathway, it's a lot more significant. And that kind of information is very useful and is actually now available for the whole UK. So we're able to screen properties, whether it be a mortgage book, insurance book, or utilities assets around the country, and actually find out which ones are hotspots of concentration. Next slide, please. And this is a bit of a kind of insurance focused slide, but the concept of AAL, so average annual loss, means effectively the expected average loss that we can expect for a given event year. And what we've done here is analyze a particular portfolio for pluvial flood, tidal flood, and river flooding. And the key point here really is we can start quantifying in financial terms what a portfolio of assets could be damaged by, what's the quantum of damage relative to the current day. So if we look now, £2 million annual loss for this particular portfolio now, or 2017 baseline, under a 2050s high emission scenario, that goes up to £3.5 million, so an 88% increase in that loss. So knowing what the increase could be will then help us to mitigate those potential risks. Next slide, please. And what we've done here as well is actually work with some mortgage lenders across the UK, and given it's important for them to assess the flood vulnerability of properties on which they've lent mortgages, because so not only the location data is important, but also the availability of insurance. So if you're lending against a 25-year mortgage, you want to make sure that that property is still insurable in 25 years. So we analysed over 1 million properties, various size portfolios from 10 different companies, and classified the risks from very low to very high based on their model flood depths currently and in the future, and then displayed that to see how those could be aggregated, the aggregate values could change over time. Next slide. And what's interesting here is if we look at the panel on the left, which is representative of a low-risk portfolio of about 15,000 mortgage properties across the UK. In this case, there's actually quite a small increase in risk exposure. So between the current risk profile and 2050s, as the clients were interested in under a medium emissions scenario. However, on the right-hand side, this is about 100,000 properties distributed more widely across the country. From the mortgage book, there's actually a much more significant increase in risk exposure, with the very high risk category going from 20% up to 33%. So that then translated to a reconsideration of what mortgage rates could be, or areas which might be problematic in the future when it comes to flood and mortgage liabilities. Next slide, please. So in terms of climate change risk mitigation strategies and what can we do now, well, one of the key things to do is actually to start thinking about what my use cases are. Is it insurance pricing, or managing accumulations of risk in particular areas, or mortgage originations, as we've seen here, as well as wider kind of portfolio or asset management if you're responsible for facilities or retail outlets or whatever it is across the country. So we need to identify the exposure to those assets at risk, both for our own properties and assets and for those of our suppliers. We also need to start thinking about how to reduce exposure to assets at risk, what's feasible, what the cost of that might be. Are there any quick wins in doing that? For building a flood defense around a particular treatment plant, for example, or do we also want to increase our exposure over time to those areas or places seen as benefiting from climate change? Because that's also the other side of the coin. And also increasingly, this kind of climate change scenario analysis has been used to reverse stress test. So what are those kind of sources of transition and physical risks that will be very difficult to withstand in the future? So sewer flooding in data centers could knock out whole companies and supply chains, and that could be a major, mission critical situation. So this kind of process helps us better identify what the likelihood and the probability might be of that in the future. Next slide, please. So that's me just about up. There was a lot to cover in 10 minutes. But one thing that we've put together for IRM members in terms of an offer, if you visit that website and enter your email address, no spamming will be involved, but what we will do is send out the expanded presentation, and also if it's helpful to you, actually have a no obligation consultation to see if we can help you get prepared for climate change scenario modeling. So actually talk through some of the situations or the assets that you have and where they are, and provide you with a bespoke asset risk report for climate change, which hopefully be a time when freebies are hard to come by, will be something useful for you and your organizations to help better communicate risk upwards throughout the organization, and also help disclose, model and plan a strategic direction for the future to deal with climate change now that's being required more by the regulators. So thank you very much. That's the end of the formal presentation. Any questions, or does that come at the end, Martin?
Yeah, thank you very much, Justin. We'll move the questions to the end of the three presentations.
Okay.
So moving on to, yeah, it was very informative, very interesting actually. Moving on to presentation by Bronwyn Clare from ClimateWise. So just a brief introduction to Bronwyn. She leads ClimateWise, which is a group of 28 insurance industry members who are responding to the risks and opportunities of climate change. Bronwyn joined CISL in 2018 from KPMG, where she worked with insurers and banks in Australia and Hong Kong to improve risk management and internal controls. Bronwyn began her career in environmental economics at the University of Western Australia, focusing a Ph.D. on the incentives during environmental sustainability. So thank you, Bronwyn. I know you're going to be covering sort of another aspect to more focused on transition modelling to a low economy. So over to you.
Lovely, thank you very much for the introduction, Martin. My presentation is going to be focused on transition risk, but I think you'll see it complements what Justin has been explaining quite well, in that there is often a general approach taken to climate risk considerations, where you set up initially what are your plans, you do the assessments and the scenarios, and then there's sort of a review process. So you'll see some similarities in what I'm saying to what Justin was also talking about here. So if we could move on, thank you. I'll just give a quick snapshot of ClimateWise. It is convened by the University of Cambridge Institute for Sustainability Leadership. And we have a wide range of members across the insurance sector, from the insurers themselves, the brokers, reinsurers, and some of the supporting firms such as the Association of British Insurers. We've been in operation for about 12 years now, and I'll go on a bit further later on about how what the key tasks are of the members and how we interact. Sorry, and thank you, thank you, Martin. Now, just to give a brief summary of what I'm going to be covering today, I'm going to give initially a snapshot of where the regulatory developments are for the sector, particularly relating to modelling of climate risk and opportunities as well, what and how to model the main risks of the transition to a low carbon economy, and then bringing in some of all of the tools and the examples from the ClimateWise membership of how they're integrating climate and transition risk management into their processes. Now, this basically covers the key snapshot of what I'm going to say in my whole presentation. So here are my key messages at the front. The standards are being set for green and brown by the market. So we're really seeing firms being asked to separate between what's good for the environment, what are we unsure about, and what needs more consideration. And policymakers and regulators themselves are also setting some very strong guidance, particularly here in the UK, and also what's happening across the water in Europe. Insurers themselves are reviewing particularly their strategies and where is their business going to be going in the short and medium term in response to these climate changes. Some of them are going to be longer term, but you can definitely see the policy changes will have implications in the short to medium term. With the UK heading for net zero by 2050, that's going to play out into the products and the offers that insurers themselves are making. So there's also on the other side of that, the stress testing of what's happening within their underwriting and investment portfolios of what is coming in from the regulator, and particularly from the Bank of England. And I'll mention that a bit more in detail. We're really seeing a focus on the potential repricing of carbon intensive financial assets. So people doing the math on how much is their exposure to potentially to stranded assets, and when is that speed of change likely to occur? Is it something that they're willing to take their time on, or do they want to be on the front foot and a progressive investor? We're also looking at how it might be adapting into their insurance premiums and how are they exposed to carbon intensive sectors. This is a major part of their markets and their clients. And how can they then actually increase their action within low carbon sectors? Are they looking at insuring more renewables? Are they considering, if they're a general insurer, what the impact of going to electronic vehicles might be on their claims book and the like? So we're starting to really see it play out in terms of the shorter and medium term. What products are you offering, and how are you going to make them work for you? So first of all, I'm going to talk, as I mentioned, to the regulatory developments. And here, while I say it's facing a turning point, I would actually say we're very much in it. Where, particularly for transition risk, we're seeing statements by the Bank of England around what their expectations are for disclosures against the Task Force on Climate-Related Financial Disclosures expectations and recommendations. We're seeing reports giving guidance coming out from, say, the International Association of Insurance Supervisors about what is good practice for an insurance supervisor globally, and then sort of how can they learn from each other, which is then feeding into reports for the industry, say from the Geneva Association or from the CRO Forum. Now, within the insurance supervisory side, what we're primarily seeing is, say, within that IAIS paper, they're making 5 clear asks for regulators to step into. So these are the things to look out for in the coming years. One is around integrating climate factors into the supervisory risk rating framework. So how are climate risks affecting the mainstream financial risks, such as insurance risk, market risk, credit risk, liquidity risk? So there's an expectation that it's assessed as part of the standard supervisory risk rating framework, and how is that update happening? The second point being is the strengthening of disclosure on climate-related information. Some of that's voluntary, but there's also hints towards mandatory. If not flat out, it will be a part of, especially the UK supervisory roles, and what that's going to look like, the level of detail and who's required is currently sort of being thought through. A third is about integrating climate-related issues into the routine supervisory review tools. So insurers' own risk and solvency assessments, so your ORSA, how is that going to be updated? Integrating climate risk into financial stability assessments, so that's that kind of stress testing, but often at an aggregated effect across the economy. And then finally, scenario analysis. Here on this slide, you can see what's happening within the United Kingdom. We're seeing the supervisory statements. You're seeing the CFRF, that joint effort between the FCA and the PRA, putting out recommendations and guidance which are related to issues such as risk management and governance, disclosure and innovation. And you can really see that science side that Justin was mentioning starting to come together with the transition and the policy expectations in the scenarios that the Bank of England is testing firms against. So down the bottom there, you can see in the different shades of the graph, the different policy or combined with different sort of climate expectations over time. So late policy movement, early policy action, or no policy change at this stage. So you can see this is becoming also more nuanced scenario analysis expected from firms. I'm now going to move into some of the modelling of transition risk itself and digging into that piece. Now here I have an example of some of the transition risk assessment methodologies. This is an extract taken from the UNEP-FI Change in Course report. In their chapter 2, they give a summary of both physical risk tools and also transition risk tools, and they lay out how you can sort of make a comparison between them. So here we've got just say 2 degrees investing and versus some of the other pieces, how they, which scenarios do they cover, what sort of risk exposure, and those risks named there are related back to the TCFD and their classifications of risks. Then thinking through the impact of the transition risk. Is it part of the macroeconomy? Are you thinking about the sensitivity and the adaptive capacity at that macro level? And as you can tell, not many firms are yet in that space with their tools, but I think it will be coming. What they're really thinking about is often the more operational level and the market level. So you're seeing people pull apart financial drivers and business operations to understand where those sort of more granular impacts are going to be. But there is also a key ask, I think, coming also from the regulators and the information they can provide when they start aggregating the stress testing results, is what's going to be happening at the macro level, and then thinking through how that might actually also affect the supply chains. It also mentions here, of course, what the output can be, whether it be qualitative or quantitative or a combination of both, and then also thinking about what level of analysis is sitting at. Some will be, say, at a country level, particularly when you're trying to pick up more macro factors, that will be quite relevant, but often they're thinking more at, say, a sector level, so you'll be able to break it down into fossil fuels or renewable energy, or even maybe a sort of a subsector level. A few of them are able to think at firm level, so then it's about which individual companies are you investing in, what is your exposure, say, to BP within that category, and then thinking through to even a facility level occasionally. So where is that power plant sitting, what sort of connection does it have to the grid, what else is in competition at that particular location. So some of the models will break it down to quite a granular piece, whereas others are more at the sort of the sector level and the like. Now I'm going to give a bit more detail about the ClimateWise transition risk framework and some of the insights that we have from our membership. Now, the ClimateWise membership, we engage in 2 primary activities. First, there's an annual independent review of your firm's integration of the 7 ClimateWise principles into your business activities. So there's a TCFD style reporting process that members go through to help put together their own expectations on progress and ambition, and then to also be able to do a peer comparison and a ranking system so that they can see their points of improvement and what they might be able to learn from the other members. And we use this disclosure effort to actually complement the second activity, which is about research. So here we were looking at the transition risk framework. It was the members seeing themselves needing the insights and the benefits of doing a detailed transition risk assessment. Of particularly here, we've looked at infrastructure investments, because this is one of the pieces that an insurance company will often look to, because it's a long-term, generally seen as quite a stable investment piece. So how does investment in infrastructure expose you to transition risk? Particularly, we did it at a sector level and subsector, so that you could think it through in terms of wind turbines or renewables, say, level, and then aggregating up into the broader, how do you see that as renewables and an energy supply asset. So our framework works on providing help to investors and insurance investors, particularly in 3 avenues. The first being around assessing the breadth of asset types exposed to transition risks at portfolio levels. So that's where I mentioned going across the different subsectors. We also cover regions and timeframes. So you're trying to think through, okay, we have a nuclear power plant that's sitting in Europe. What's the exposure on that compared to a fossil fuel asset sitting in the US? So you can then start to see what's going to bring out a low, medium or high risk exposure for that investment. And then think through what changes do you want to make in the sort of short term, medium term or long term for your whole portfolio and that aggregate position. You can then also use the framework to define a more detailed granular level in the second stage, looking at potential financial impacts of the low carbon transition down to the particular asset levels. So we've given quite an open source model where you can look at what data we've pulled out of, say, the International Energy Association's reports and think about it in your own context. What are you holding? Well, actually, we can break it down from Europe. We know that our asset's sitting in Germany, and these are the sorts of information we need to consider for a German asset. And then finally, you can take it also and pull out even the down to the revenue level. Okay, it's what sort of revenue exposure for a particular asset versus the sort of cost implications for OPEX and CAPEX, and really do a more detailed financial model expectations for what you're holding over the long term, and whether that's an asset you want to keep, or whether it's an asset you want to continue with, or also then for new purchases particularly. Now, I'm going to mention some of the insights that have come from our members during their reporting process for last year. Principle 2 is about the incorporation of climate-related issues into strategies and investments. So here you can see members are looking very much to, as I mentioned at the beginning, about repricing and thinking about also consumer choices, the types of products that they're going to be offering to their members going forward. But we also are asking our members, we're seeing opportunities for increases in the information that they provide available here. And also then I'll mention just also the principle 3, the lead in identification, understanding and management of climate risk. And you can really see here that on the underwriting side, what tools they use to monitor their exposure, what investments they are looking to increase or step back from. And then also the next step within the members is really how do you combine those two pieces? Where does the physical risk and the transition risk come together? Thank you, Martin.
Thank you very much. That was very comprehensive and, like I say, very complimentary to Justin's presentation. We're going to now move on swiftly. I know we're going to be time constrained, but hopefully we'll still have 10 minutes for questions at the end. Going to move on now to Srini's presentation. So Srini is a technology entrepreneur with a passion towards natural resources, sustainability, and poverty alleviation. That was what he provided to me in a sentence. He's going to be covering parametric insurance for risk managers and also talk about sustainability bonds. So over to you, Srini.
Thanks, Martin. Pleasure, everyone. It's very good to be here, and we saw a couple of very nice presentation on physical risk and transition risk. In our scenario, primarily we look at sustainable development goals as what do you call a 30,000 feet message. Globally, when you look at risk managers, whether you do look at it on a country level or you look at it on a corporate level, we are committed as countries to meet the sustainable development goals. And we do tend to work in a structure, you know, if you're thinking about an insurance risk manager versus a risk manager who is working in a bank or a fund, there's very clear legal regulatory structures under which you operate, but they don't necessarily talk to each other that often. However, when you're meeting sustainable development goals, it is very important for those two to come together. And in what sense they can come and make an impact is what the focus of the business has been. So I'll probably cover 3 major questions which we talked about. If you go to the next slide, please. One is how parametric insurance could help risk managers in terms of assessing the risk from a physical point of view and also transferring some of the risk to the insurance market. And then the second complementary topic is more about capital markets, on what's the role of capital markets in terms of handling the transition risk, which is facing every part of the globe. If you go to the next slide, please. So in a nutshell, you know, most of the insurance risk managers have a very good understanding about how do you create an insurance product. Parametrics in many ways is not broadly dissimilar, but what parametric does really well is if you think about world as a system, we all are interconnected in many ways. When you take a land as a system, when you take energy as a system, buildings, transport, they're all interconnected where human beings interact with natural resources in many ways. There are some static resources, there are some moving resources, but ultimately we are consuming and we are working in a system. And the whole idea behind parametric insurance is if each and every system that you're looking to model can be represented using a set of parameters, A, you can understand those systems a little bit better on how they're interacting. B, you can understand their health, and also C, you can understand some other risks. And these risks which you can retain as a business, you will be retaining it and looking to manage and looking to control. Whereas if you are looking to transfer some other risk to the insurance market or capital market, there are financial instruments that are available out there. And that's effectively what parametric is all about. So you could generalize it across healthcare, you can generalize it across certain kind of physical assets that we have, such as energy, such as like buildings that we have. But the overall concept is all about an insurance company and an insured can come together. They can look to understand the systems on the basis of which they're operating, or they set up parameters which can really give you a good link about the risks and also the financial output. And if you're able to understand them, then you are able to monitor them, you're able to price them. And then when a bad event happens due to natural catastrophe, because of the nature of transparency, it's a lot easier for you to interact and then mitigate the risk. That's the whole nature of it. We move to the next slide, please. So in a simplistic sense, why would I adopt a parametric insurance compared to any other? There's obviously a very clear relationship between an insured and an insurance company. So whether you're a corporate risk manager or you're managing basically a municipality from a asset point of view, or you're looking from a country level, when you talk to an insurance company, it's extremely important to get the right coverage for your business or for your entity. So the bespokeness is very, very important, where no two assets are the same. Secondly, claims cost is something which becomes very, very hard, especially in rural markets when you operate. Many of these rural areas basically haven't got any clear infrastructure. So trying to assess the impact of a natural catastrophe is extremely hard business, which would mean that you would incur a lot of cost in loss assessment. With parametrics, it is fairly transparent in the way an insured and an insurance company can engage. That really helps you to get to the payout a lot more faster. And the most important element here is the win-win outcome. It is in basic one-way traffic where an insured basically gets the raw deal or the insurance company gets the raw deal. It is a collaborative two-way partnerships. We go to the next slide, please. So in a nutshell, most of this parametric, you would probably see they go in many ways. There are companies who actually offer parametric coverages using natural disasters or natural hazards. In this case, it can be a drought, can be related to flood or cyclone in emerging markets. You could be parameterizing for your business against heat wave. We have seen in winter times, there's a lot of frost-related damages that happens as well. And recently wildfire, which has been becoming one of the common issues that's facing globally due to the climate change. So in essence, you can parameterize against multiple perils. We go to the next slide, please. There's just quick couple of examples that I have before we talk about the bond side. So in a simplistic case where if you're a risk manager, we're looking at a heat wave policy. Naturally, this applies on the retail market where heat wave could affect companies. Heat waves could affect small businesses, for example, like people who are selling ice creams. There's a lot of initiative that's been done in terms of understanding the weather. In many ways, if you're looking at a particular asset, you're interested in two main areas. Historically, what's been the kind of heat wave pattern that's been happening in a given geolocation. So for that, you can actually study the historical data. And one of the areas where there's a lot of innovation that's been happening from a technology point of view is just like you are insuring a car where you have telematics data, which is measuring car performance on a daily basis and driver's performance. You could be putting sensors in a farm, which is something we do quite often in the heat wave policy. You could be having sensors in the cargo in the ships. You could be having it in buildings. And the idea is to understand these sensors will give you a much more real-time indication about what's really happening in that particular location. So that would allow you to set the most appropriate trigger and the payouts. So that's the essence. But you could replicate it across the other peril as well, which I got it in the following slide. So if we move to the next slide, please. So this is related to hail. Again, it's a very localized impact. So you could have a sensor which can actually detect the hail in real time. So it looks at the intensity, looks at the severity as well. And what it allows you to do is to actually price the hail risk if it affects your farm or if it affects your building. We go to the next slide, please. So on the second element of it, given the nature of what capital markets can do, so most of the times when you talk about transition risk, obviously it applies to everyone. It applies to governments, it applies to municipalities and corporate world. We're looking at a long-term phenomena here where if you'd like to transform your country or a corporate business to a climate resilient world, it is important for you to think about what's the most appropriate financing to be in place. In many of the markets, like emerging markets, they do rely upon a very inefficient capital market structures, such as local banks, such as non-banking financial corporations. But the bond market, it's a multi-trillion-dollar market. It can offer you a lot more flexibility in terms of what assets you can actually bring to the table in terms of raising financing. And this, when it actually works along with the insurance, you're looking at basically an investment going in for 10 years, and that is coupled with an insurance wrapper, which could actually become your resilience component. That's in essence means your capital market and insurance can actually work hand in hand so that a country or a corporate can clearly define where they would like to get to in the next 10 years and how they can actually raise the capital at a cheaper cost of capital. At the same time, the worst case risks are transferred to the insurance market. So your default risk basically reduces in the long term. If you go to the next slide, please, which is my last one. So in essence, for anyone who is looking to issue a bond, there are a number of services that you could provide. One is them understanding what the sustainable bond framework would be. That could be a green bond, it could be an ocean bond, it could be related to brown in some cases, where you're less polluting than what you're polluting before. And the idea is you actually create a framework, then you structure the bond, you can look at guarantees. In form of insurance wrapper, it could be used as a credit enhancement tool, as I was saying before. And these kind of tools would allow you as a risk manager to think about not necessarily the liability side of things on your assets, but also looking at the capital structures and see what is the best way to capitalize the transformation that you would like to create. So with that, come to the end of the presentation. And overall, the one message that I would leave out to the community is, in many ways, the regulators are doing an excellent job in this part of the world. But as a risk manager, you're always forward-looking, where you're looking at the physical risk as one side. You're also looking at a strategic view as an organizational side on the transition risk side. So you need technology and you need data to help you to create new financial products. And I'll stop it at that.
Thank you very much, Srini. We're sort of running out of time because obviously the presentations were particularly insightful. So I'm going to pass over to Clive now just to run some Q&A.
Thanks very much. Thanks very much, Martin. And I thought those presentations were excellent, and thank you all for that. I know that I'm looking at a chat panel in front of me, but I don't see any questions coming through. But from the 50-odd attendees we've got listening into this, if you are trying to get some questions through, I hope that they'll come through. If they don't, as I say, I'm not seeing anything at the moment. But if they don't, and you want to try and you want to ask a specific question, I'm sure you can pass that through to Martin, or in fact to Juliet or any of the speakers. I'm just going to go through each of the individual presenters, and I've just got a few questions. I've got quite a few questions really, which arise as a result of that. But Justin, I was really interested in you taking modelling out to let's say 2080. I would think there are a few issues involved in that, and I'm just wondering if you could maybe talk us through some of that. In terms of the, I'm also thinking about risk velocity is one of the aspects that that strikes me about that, and when we can expect like you say, the worst to happen. Maybe you can comment about some of those issues around the timing of these events.
Sure. I mean, obviously, the further out we try and look, the higher the uncertainty is associated with the modeling. But at the same time, when we're looking like flood, we're looking at a peril like flooding, we can look at it over any kind of time scale, really. And I think we're seeing increased interest in what's happening over the next 5, 10, 15 years as well. But it's just that for the UK climate programme, the information that we get from the Met Office gives us those time epochs. So we're kind of constrained to some extent in the UK with the time horizons that we model directly, but we can also kind of interpolate between those. So in the UK, we're very lucky in that the projections for increased precipitation and flows in rivers are carried out at a very granular scale on a kind of watershed by watershed basis. So we have the numbers in terms of uplifts, or in sometimes the discounts, if you like, onto the river flows in various parts of the country, with which we can then carry out the models. So, you know, as I say, in the UK, we're very lucky that we've got that climate model downscaling to use those epochs. But essentially, you know, the scenarios that I just showed are a couple that particular customer was interested in us looking at for 2050 and 2080, and we can look at other time periods as well. But it's going to take a while as well for other parts of the world to make the climate models more accessible, or kind of publish generalized ways for which kind of, you know, climate change modeling should be done in the US, for example. So that's another area of interest for us and our clients, to look at how, for example, storm surge might change in the US, as well as riverine flood and pluvial flood, because, you know, what we do on a 1-year horizon might be different to what we should be doing on a longer term horizon. So, you know, thinking strategically, what is the strategic approach, and what can these results do to help us see if that the longer term approach is compatible, and we need to change trajectory, because that's what it really comes down to. Does that answer the question?
It does. It raises more questions, I think, as well, in terms of if you factor in your supply chain, and I suppose possibly as a result of the pandemic, we might be looking at shortening supply chains as opposed to lengthening them, and especially if you factor in these this climate change issues as well, because I would have thought, maybe intuitively I'm being wrong, but maybe you've got weaker sets of data, kind of the further out you go from the if you could call it the developed world or whatever. I don't know if you go into Asia. I don't know if you have very good models for those sorts of areas.
Well, again, with flooding, one of the principal controls on model accuracy is the digital terrain model, and, you know, every year we get better and better quality data, whether it comes from satellites or photogrammetry from air photos, etc. So, yeah, parts of Asia are very difficult. US is very well covered with data. UK, Australia as well, very, very good quality data. And we're actually building this product out for Western Europe now as well. So looking at climate change flood risk for Europe. So, you know, the climate models are there, and we've developed methodologies for scaling what we've done in the UK to elsewhere. But it's really, it's actually, you know, the other types of ancillary data which could be hard to get hold of in places like Asia.
Fascinating. Thank you very much, Justin. I'm sure our audience will be picking up on some of that as well. Bronwyn, I'd like to come to you. Fascinating presentation there. And I'm just picking up on what you were saying at the start around regulation. I guess this is a kind of a push from regulators, and as well is pushing the insurers or financial institutions to do things. Do you think that the regulatory push is being affected by either, could we say, the geopolitical situation as it arises, and also, you know, has or will, do you think the pandemic will have an effect or an impact on how regulators will address this situation?
My opinion on the pandemic impact would be that I think we're seeing sort of a micro pause, like a sort of a stop, while everyone sort of does the rejig to get working from home, getting their family life settled, making sure everyone's healthy and safe. And then I think it's at the same time highlighting to everybody the sensitivity of our environment and making them much more conscious of the broader impact of climate change and how it's going to need to modify our lifestyles. So I feel like the pandemic's sort of both pausing it, but then also reigniting the discussion. And what I'm seeing then in terms of the geopolitical is that there has been a lot of broader conversations, say like in the US, even on the Black Lives Matter and the broader social purpose of firms and how is society itself constructed, I think is leading to broader conversations about regulation and how do you do assessments for impacts that happen to a broader society and the purpose of a firm. And that's then I think spilling into sort of the C-suite and the regulatory conversations about the purpose of a firm and where they themselves can respond and be more progressive. In terms of the difference between different locations, I think you can see people are very conscious of what's having the physical impact within their backyard and what they're capable to do as a sovereign nation. So really thinking through, so what sort of sovereign wealth funds exist, what are our large fossil fuel holdings that we might rely on as an economy, and sort of then thinking about sovereign exposure. You can see that in some of the work that's being done by like credit rating agencies or some of the bigger research houses about how sovereign risk is changing because of climate change. So I think that those sort of geopolitical issues are definitely playing out and being part of the assessments that individual firms are having to make.
Fascinating. Yes, thank you. I think I tend to agree with you about the ESG impact on the board as well. And I guess integrating these things is going to be the challenge of the next decade, or however long it will be, going out to 2080 possibly. But thank you for that. Thank you for that, Bronwyn. Srini, again, another fascinating run through parametrics and what you're doing there. I just wondered if you could maybe give us a view of where you see practically any the growth aspects of coming through, or any if you're seeing any elements of any particular sectors taking up parametric causes.
Yeah, so definitely the drivers naturally do tend to go alongside with the explosion in technology and data in general. If you look at the Western markets, I would include the European side and also the US. It has been tried on a sporadic basis by looking at certain property asset classes. For example, there are parametric policies that are available for what do you call the automotive sector. There are few coverages which has been done in the marine industry. We've done a few in the agricultural sector. But overall, penetration wise, it is still early days as far as risk managers are concerned. They are looking at, okay, if we do collect data, how long does it take before the data becomes viable? With all the innovation on drones and satellites, there's still a lot of the satellites actually hasn't been up there for a decade. They've been up there for like 2-3 years. Now, as a risk manager, it's not going to give you sufficient enough look back window to actually assess the risk. So there's an element of what data you currently have about that particular peril and what data you could potentially collect by instrumenting it. It's what generally drives the strategy. However, in markets such as emerging market, you could be looking at both ways, where it would take a long time for you to collect the data before it becomes useful for the financial product. That's one way you could be looking at it. The other way you could be looking at the same problem is, if there is no such data is available, then you start with an uncertainty reduction principle in a Bayesian way. So you would start to look at what basically are measuring and what's the overall kind of variance that you could actually see in that parameter, and start to take an educated guess about what pricing it needs to be and the rate of decline. And then as you start to collect more and more data, you become much more certain. And that's something means a lot of emerging markets, in the absence of any historical events or any historical reliable data, parametrics gives you that step change that you would like to see. compared to how we are seeing in this part of the world, where it has been a progress, but it's been a slow progress.
Thanks, Srini. So we are sort of reliant upon the data, and I'm sure that data will be, will be enriched as we go further on in time, and it's something we definitely need to keep an eye on. Well, thank you very much indeed for all the presenters. Thank you very much for all the attendees who've attended this session and remained on. I noticed that we've got 43 now. So thank you again. Can I just remind you, with my hat as the Deputy Chair of the IRM, if any of you are not members and you want to become members, please visit our website and or send an email from the into Juliet, who'd be very happy to work with you around joining. If you're interested in training, I know that we've Martin is working on a training course for climate change, specifically for risk managers, and we're working on that with Imperial actually. So something will be coming out there. And of course, if you are a member and you want to get involved and you want to become involved with this group, with the climate change group and the management committee, I'm sure Martin would be very, very pleased to hear from you. So with that, it's now 5:05, and I'm very sorry that we've overrun our time, but I hope you all enjoyed that particular session. And I'm going to say goodbye and just say, Martin, if you want to do any wrapping up, or should we? I'll leave it over to you.
Thanks very much, Clive. I think you've done most of the wrapping up. I just want to say, yeah, we are looking for people to support the committee. There's lots of opportunities to do research and look at best practices. And you can see from the various presentations today that there's a lot of development, and we're looking for people from different industry sectors as well. So if you're interested in joining or supporting the committee, then please get in touch. And thank you for attending today.
Great. We had one question saying, will we be sharing the slides? And I think the intention is that we are going to be sharing the slides.
Yes, we'll be sending the slides, and we're in touch with the IRM, and normally will be on the website.
Great. Thanks very much, Martin. Okay, well, thank you very much, everybody. And I'm going to go. So goodbye.
Thanks, Martin. Thanks, Clive. Thanks, everybody.
Thank you.
Cheers, bye.
Thank you.